Hello, today I'd like to introduce the book John Bogle's The Little Book of Common Sense Investing. The author is the creator of Vanguard Fund as well as a big proponent of index fund investing. And the book's core message is that we must passively invest in index funds in order to maximize profits over the long term. Most investors and most Wall Street experts choose individual stocks in individual categories or put their money in actively managed funds in order to gain better than market profitability. However, according to the author, this strategy is essentially a loser's game, and in the long run, people tend to lose money. Here, the author outlines four major principles. First is that we must use index funds in order to passively invest in order to minimize costs. The second is that we must also diversely invest in order to reduce exposure into the risk of, say, one individual sector or one individual stock. Third, we must always have patience and never invest with our emotions. Finally, fourth, the stock market is a market in which you can profit over the long term. Using these four principles, we can clearly see that the author stresses the importance of minimizing costs. And this is why actively managed funds are just so bad in terms of long-term profits. Since actively managed funds trade always, constantly, they always have high fees, and these fees tend to accumulate, essentially eating away from the market return. Yet, Wall Street and financial experts who want to actively push their financial instruments, their financial products and funds, always tell the public that these actively managed funds or actively managed strategies can get you better than market returns. Since experts manage these kinds of funds, you can get better than market profit, get better than average profits. However, according to the author, no one can predict future returns using past performance. Even the best of investors over the long term lose out and instead revert to the mean, revert to the average. Just because you had 10 years of good exposure, good performance, doesn't mean the next 10 years. In fact, in the long term means that the next 10 years you will have worse than average performance. This can be compared with coin flipping. If you ask 100 investors to tell which side of the coin will land on, about 100 out of 100, about 50 will get it right. If you do the experiment again with the remaining 50, about 25 will get it right. Over the long term, instead, the performance of each individual investor tends to revert to the mean. This means that choosing our stocks and choosing our stock brokers and fund managers based on past performance is like putting our money with people that just happen to get their coin flipping right. In the end, we all revert to the mean. We all revert to the average market return. Then, what do we need to do? The only returns that we can safely expect is the average market return. In essence, how much the stock market on average produces. This means that instead of trying to maximize profits, we must put our focus on minimizing fees, minimizing costs. Therefore, a widely diverse index fund is the way to go. This kind of advice is very practical, not to mention very simple. and very, very, very much what the average beginner investor needs. Then, which index fund does the author recommend? The answer is simple. Whichever index fund is capital efficient, tax efficient, and has the lowest fees. Any other marketing, any other uh, uh, any other icing on the cake conditions are just that, marketing and not of any substance. In the long term, all index funds are the same, and the market return is what we can safely expect from this kinds of investment. I've read a lot of books and a lot of books about investing, and out of them, this book was a bit more boring. Instead of putting the focus on profits and mind-boggling returns, this book focused on costs, about taxes, fees, time commitments. This kind of content is very much more stale than what we would expect from an investing book. However, thinking about it, this kind of investing strategy is the most basic, is the most simple, and something that we must all master first before moving on to other strategies. Thank you for listening. Have a wonderful day.